So you want to own a movie theater. Picture it, velvet seats, a giant screen, the smell of fresh popcorn drifting through a lobby lit in neon and gold. Every weekend, hundreds of people walk in, hand you their money, and sit quietly in the dark while your product plays itself. No inventory to restock every hour. No haggling, no delivery drivers. Just people, popcorn, and a story. It feels like the perfect business. You don't even have to make the product. Hollywood makes it for you. But here's what almost nobody outside the industry understands. The movie playing on your screen is not really your product. It's a loss leader. And the company that made it is about to take most of the money you just watched change hands. That's only the beginning. The real story starts after the lights dim. Let's start with what a movie theater actually sells. On the surface, it sells tickets. But financially, a theater is closer to a real estate operation wrapped around a concession stand, with movies used as the excuse to get people through the door. That single idea explains almost everything strange about how this industry makes and loses money. Here's why people assume theaters are profitable. A single auditorium can hold 200 to 300 people. At roughly $10 to $12 a ticket in the United States, one sold-out showing brings in over $2,000 in about 2 hours. Multiply that by 8 screens, several showtimes a day, and a full weekend, and the revenue numbers look enormous. A mid-sized multiplex can generate over $1 million a month in ticket sales alone. That sounds like a business printing money, until you look at where that money actually goes. When a blockbuster opens, the studio that produced it doesn't just hope for a cut, it negotiates a contract that heavily favors itself in the first 2 weeks. Industry-standard film rental agreements typically start around 60 to 70% of box office revenue, going to the studio in a film's opening weekend, gradually shifting toward the theater's favor the longer the film stays in release. By week 4 or 5, the theater might keep 60 to 70% instead. This is why theaters push so hard for opening weekend crowds and long runs, and also why a movie that flops in its first 10 days can leave a theater with almost nothing to show for a packed house. So if tickets barely break even during a film's most popular weeks, how does anyone make money running a cinema? The answer is sitting in your hand the moment you walk past the box office. The concession stand. Popcorn is one of the most profitable products sold anywhere in retail. The corn itself, the oil, and the packaging for a large popcorn might cost a theater somewhere in the range of 50 cents to $1. That same bucket sells for $7 to $9. Soft drinks follow a similar pattern, syrup and cup costs measured in cents, sold for prices that rival a fast food combo meal. Industry estimates have long placed concession profit margins above 85%. Some analysts say closer to 90%. This is why theater staff are trained to upsell a large popcorn for $1 more. Why combo deals exist, and why concession stands are placed directly in the walking path between the entrance and the auditorium doors. It isn't an accident of architecture. It's the actual profit center of the business, engineered into the building itself. Roughly speaking, industry data suggests concessions can account for a third or more of total revenue at a typical multiplex, while contributing a majority of net profit, because almost none of that money has to be shared with the studio. Now think about what that means. The movie isn't the profit engine, it's the bait. The theater is, in economic terms, a marketing platform for snacks. But running that platform is far more expensive than it looks from the lobby. Start with the building itself. A modern multiplex with 10 to 16 screens can cost anywhere from $5 million to over $20 million to construct, depending on location, screen count, and premium formats like IMAX or Dolby Cinema. Even if you're leasing rather than building, prime real estate near shopping centers and residential density, the exact locations theaters need to survive, comes with commercial rents that can run into hundreds of thousands of dollars a year per location. Then come the projectors. When the industry shifted from film reels to digital projection in the 2010s, each digital projector cost somewhere between $60,000 and $150,000 per screen. For a 12-screen theater, that conversion alone could exceed $1 million. Studios helped offset this cost temporarily through what were called virtual print fees, essentially paying theaters small amounts per digital screening in place of the cost they used to bear shipping physical film reels. But that subsidy period ended years ago, and now theaters absorb equipment costs, including surround sound systems, premium large format screens, and reclining seating installations that can run several $1,000s per seat. Labor is another constant drain. Projectionists, ticket staff, concession workers, cleaning crews, and management all need to be paid whether a theater is packed or nearly empty. Because a theater has to remain open and staffed on a Tuesday afternoon just as much as a Friday night, even though attendance can differ by a factor of 10. And then there's the risk almost nobody talks about, the release calendar. A theater's entire cash flow depends on what a handful of production studios decide to make and when. If a mega franchise film underperforms, or a major release gets delayed, as happened repeatedly during 2020 and 2021 theater's monthly revenue can collapse overnight with almost no ability to control it. Unlike a restaurant that can adjust its own menu or a retailer that can restock different products, a theater's core inventory is decided entirely by outside companies months or years in advance. This is where the real fragility of the business becomes visible. Look at Cineworld, the parent company of Regal Cinemas, one of the largest chains in the United States. In 2022, Cineworld filed for Chapter 11 bankruptcy protection. Weighed down by roughly $5 billion in debt, much of it accumulated through an aggressive series of acquisitions in the years before the pandemic. The company had been betting that continued box office growth would let it service that debt. Then attendance dropped sharply during pandemic closures and the slow theatrical recovery that followed, and the math stopped working. AMC Entertainment, the largest theater chain in the world, tells a similar story from a different angle. AMC carried billions in long-term debt heading into 2020, then watched its revenue crater by more than 75% during pandemic shutdowns. It survived largely by repeatedly issuing new shares of stock to raise cash, diluting existing shareholders, in what became one of the most closely watched corporate survival stories on Wall Street. AMC didn't stay alive because movie theaters are inherently strong businesses. It stayed alive because it could keep finding new investors willing to bet on a recovery. Smaller chains weren't as fortunate. Studio Movie Grill, a dine-in theater concept, filed for bankruptcy in 2020. Alamo Drafthouse, known for its strict no-talking policy and curated film programming, filed for Chapter 11 in 2021. Both eventually restructured. But the pattern was clear. Even beloved differentiated theater brands weren't immune to a business model with razor-thin margins and enormous fixed costs. And then there's the streaming problem, which didn't create these weaknesses but exposed them brutally. As studios began releasing films simultaneously in theaters and on streaming platforms, or shortening the theatrical window before a movie became available at home, theaters lost one of their oldest advantages: exclusivity. Why plan a trip, pay for parking, buy tickets, and pay theater prices for snacks, when the same film might be available on a subscription you're already paying for within a matter of weeks? Theaters that survived did so by leaning even harder into what streaming can't replicate. IMAX and other premium large-format screens offering a scale and sound experience impossible to recreate at home saw disproportionate demand recover faster than standard screenings. Dolby Cinema, reclining leather seating, and dine-in service became less like upgrades and more like the actual reason to leave the house. MC Stubbs A-List subscription, letting members see a set number of movies per month for a flat fee, mimicked the psychology of Netflix, turning an occasional purchase into a recurring habit. There's a strange parallel worth noting here. MoviePass, the startup that briefly let subscribers see unlimited movies for around $10 a month, collapsed spectacularly in 2019 because the economics were mathematically impossible. It was paying full price for tickets its subscribers used constantly, while collecting a fraction of that in subscription fees. It's a useful lesson in just how unforgiving this industry's margins really are. A business model that ignores the studio's cut, the fixed cost of an empty auditorium, or the razor-thin margin on tickets doesn't survive contact with reality for long. So who actually succeeds in this business today? The chains that succeed tend to share a few traits. They control real estate costs carefully, either through favorable long-term leases signed decades ago or ownership of key locations rather than pure rental exposure. They diversify revenue beyond the auditorium. Some theaters now generate meaningful income from private event rentals, corporate screenings, and alcohol sales, which, unlike popcorn, come with their own high margins and growing demand among adult moviegoers. And they invest heavily in premium formats, because the data is consistent. Audiences will pay significantly more for an experience they genuinely can't get at home, even while cutting back on standard screenings. Independent art house and boutique theaters occupy an entirely different niche. With lower overhead, curated programming, and loyal local audiences, some have proven more resilient than massive chains carrying hundreds of millions in acquisition debt. Size in this industry isn't automatically an advantage. it can just as easily mean a heavier weight to carry when attendance dips. So, is owning a movie theater actually worth it? The honest answer is that it depends entirely on what kind of theater you're running and what decade you're running it in. As a pure ticket-selling business tied to a handful of Hollywood studios controlling the content and the contract terms, the margins are brutally thin, the fixed costs are enormous, and the risk of a bad release slate can sink an entire quarter. But as a real estate-anchored concession and experience business, one that treats the movie as the hook rather than the product, theaters can still generate real, durable profit, especially at the premium end of the market. The next time you sit down in a dark auditorium with a tub of popcorn in your lap, remember what you're actually looking at. You didn't just buy a movie ticket. You walked into a business engineered around a razor-thin margin on the very thing it's named after, kept alive by markup on corn kernels, and betting every single day on what a handful of studios decide to release next.